Hello everyone, and welcome back. In this lesson, we're going to tackle a crucial topic: indicators and tools as confirmation. We'll explore how to use traditional technical indicators not as standalone signals, but as powerful tools to reinforce the core concepts of smart money. Let's start with the introduction. Smart money concepts, or SMC, is all about understanding liquidity, market structure, and institutional intent. The most important takeaway from this entire lesson is this: indicators are not signals. Repeat that to yourself. They are tools, and only tools, to confirm or strengthen a bias you have already formed within the SMC framework. So, what is the role of indicators in SMC? Simply put, they should support, not define, your trade decisions. They help validate what we're already seeing on the chart, like a strong displacement, a shift in market structure, or unusual volume strength. They offer that extra layer of confidence in an SMC setup. Now, let's overview the key tools we'll be discussing. We're going to explore how each of these complements SMC concepts. They are Fibonacci retracement, or FIB, moving averages, or MA, the relative strength index, RSI, the moving average convergence divergence, or MACD, and on-balance volume, OBV. First up, Fibonacci retracement. The FIB tool measures potential retracement levels based on a prior price move. In SMC, we align it with our discount and premium zone logic. The key retracement levels we focus on are 0.62, 0.705, and 0.79. These discount zones often align perfectly with fair value gaps or order blocks for potential entries. Conversely, the premium zones help us identify take-profit levels. The visual here shows the optimal trade entry, or OTE, zone within a dealing range, bounded by these key Fibonacci levels. So, how do we use FIB for confirmation? After a strong displacement, you draw the Fib tool from the swing high to the swing low. You then look for the price to retrace back to those key levels, 0.62, 0.705, and 0.79. Often, this is where you'll find a FVG or an institutional entry zone waiting. This helps confirm our discount logic. It's especially useful when multiple FVGs form, and you need to pinpoint the highest probability entry. But remember, only use FIB after you've established your structural bias and seen a liquidity sweep. Next, moving averages. MAs smooth out price action to show the general directional flow by plotting the average closing price over a set period. In SMC, they help us confirm the overall trend bias and validate whether a displacement is significant. As a confirmation tool, we often see the 20 or 50 period exponential moving average aligning with FVG zones during a retracement. The basic rule is, if the price is above the MA, the trend bias is bullish; if it's below, it's bearish. When a break of structure or a market structure shift occurs right at a dynamic moving average, it significantly strengthens our bias. Furthermore, a moving average crossover happening near a displacement can confirm the direction of institutional flow. As the note on the slide says, the price is clearly respecting the 60 EMA. Now, let's talk about the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. For us in SMC, it's not about simple overbought or oversold signals. We use it to spot divergences and understand momentum shifts. A key confirmation is when the RSI makes a higher low while price makes a lower low. This is a bullish divergence, suggesting weakening selling momentum right after a sweep of liquidity. This often precedes a strong move back in the opposite direction. It helps us confirm that a structural shift is backed by momentum. Moving on to the moving average convergence divergence. The MACD shows the relationship between two moving averages, typically the 12 and 26-day EMAs, and their momentum. It helps us confirm the momentum behind a displacement or a structure break. For SMC confirmation, we watch the MACD line in relation to its signal line. When the MACD line is above the signal line, it often confirms strong, genuine displacement. When it's below, it can warn of a potential fake break of structure or a liquidity trap. The crossovers that happen right after a liquidity sweep are particularly powerful, as they often align with true institutional intent, as shown in this strategy example. Our final tool is on-balance volume, or OBV. OBV tracks cumulative volume flow to answer a simple but critical question: is volume supporting this price movement? As a confirmation tool, a rising OBV confirms a bullish trend, while a falling OBV confirms a bearish one. Most importantly, a divergence between OBV and price, where price goes one way but volume goes the other, suggests internal liquidity manipulation by smart money. When you combine an OBV divergence with a FVG or a break of structure, it gives you tremendous confidence in your directional bias. So, how do we bring this all together? Here's a sample workflow. First, you identify a liquidity sweep. Then, you confirm the market structure shift and displacement. And let's be clear about what we're looking for. Displacement is that strong, impulsive move that shows clear institutional intent. It's not a slow grind, it's a powerful leg that often creates a fair value gap, or FVG, which becomes our key entry zone. Once we have our displacement and the resulting FVG, we wait for a retracement back into that FVG. Our entry is placed within the FVG, but only when it's aligned with a confirmed structure shift. Our stop loss is placed strategically below, or above for a short trade, the liquidity sweep level, or below the first candle of the FVG itself. This checklist illustrates the setup following a liquidity sweep perfectly. Now, with that core SMC structure in place, the sweep, MSS, displacement, and FVG entry, we then bring in our indicators for the final confirmation. 3. Check FIB retracement alignment. 4. Validate momentum with MACD or RSI. 5. Confirm volume bias with OBV. The key is that all these tools are serving to validate the same, single narrative of institutional activity that we first read from the pure price action. Let's consider a practical example. Imagine a bullish setup after a sweep of the Asian session low. You see that the Fibonacci retracement aligns perfectly with a key level and a FVG. The RSI shows a bullish divergence, indicating momentum is returning. The MACD histogram turns positive, and the OBV line is rising. This confluence of factors strongly confirms an institutional buy entry zone. Now, let's talk about what not to do. Common mistakes include over-relying on indicators instead of pure structure, using lagging signals without the context of liquidity, ignoring the foundational elements of liquidity and displacement, and, perhaps the biggest one, confusing a confirmation for an entry trigger itself. So, what are the best practices? Always start with structure, liquidity, and session timing first. Your analysis must be built on that foundation. Only then do you add indicators for validation. Use confluence of signals, not clutter. And keep your charts clean. Focus on the logic and the probability, not on how many colorful lines you can fit on your screen. To summarize, indicators are powerful allies that support the SMC framework by confirming structure, momentum, and volume intent. To recap, FIB confirms our discount and premium logic. Moving averages confirm the trend flow. RSI and MACD help us gauge momentum. And OBV confirms volume intent. Remember, use them as confirmation tools, not as the decision makers. The decision always comes from the structure itself. That concludes our lesson. Thank you for watching, and I'll see you in the next one.